What if I told you that every dollar you put into your 401k, every share of an S&P 500 ETF you buy, doesn't just buy you a dollar's worth of the market? What if that single dollar, your dollar, was actually responsible for increasing the total value of the entire stock market by $5? It sounds impossible. It defies the very logic of buying and selling. Yet this is precisely what a groundbreaking and deeply controversial economic theory is now claiming. It's an idea that suggests the very foundation of how we understand stock prices might be flawed. For decades, the story we've been told about the stock market is one of cold, hard logic. It's a vast, efficient machine, we're taught, a great weighing machine that sifts through every piece of news, every earnings report, and every economic forecast to produce a fair and rational price for every stock. But what if it's not a weighing machine at all? What if, in reality, it's more like a swimming pool, and the price is just the water level? And for the past few decades, we've been pumping trillions of dollars into it, wondering why the water level keeps rising, regardless of whether it's sunny or stormy outside. This is the story of the Inelastic Markets Hypothesis. It's a theory that challenges half a century of financial orthodoxy and offers a startlingly simple and perhaps terrifying explanation for the relentless climb of the stock market. And more importantly, it holds a stark warning about what could happen if the flow of money ever stops. To understand the revolution, we first need to understand the old regime. For over 50 years, the dominant idea in finance has been the efficient market hypothesis, or EMH. Popularized by economist Eugene Fama in the 1970s, the EMH is elegant in its simplicity. It states that asset prices, like stocks, fully reflect all available information. This means you can't consistently beat the market, because any information you might have is already baked into the price. Think of it like a crowded supermarket checkout line. If one line is visibly shorter, people will immediately move to it, and it will quickly become just as long as the others. In the same way, if a stock is obviously underpriced, investors will rush to buy it, pushing its price up until it's fairly valued. The market, in this view, is a self-correcting organism, always seeking equilibrium. The legendary investor Benjamin Graham, Warren Buffett's mentor, captured this beautifully. He said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine. The daily fads and fears are just noise. Eventually, the market will accurately weigh a company's true, fundamental value. Under this model, your decision to invest $1,000 into an S&P 500 index fund shouldn't really move the needle. Why? Because the market is assumed to be elastic. For every buyer like you, there's a rational seller on the other side, ready to part with their shares at the fair market price. Your small purchase is just a drop in an ocean of perfect supply and demand. The price impact is fleeting, insignificant. This theory has been the bedrock of modern finance. It's the intellectual foundation for the rise of passive investing itself. After all, if you can't beat the market, why try? Just buy the whole market through an index fund and hold on. For decades, this elegant, reassuring story has been the gospel. But what if the gospel is wrong? In 2021, a paper by economists Xavier Gabay and Ralph Koijin sent shockwaves through the academic world. Their research proposed something radical. The market, they argued, isn't elastic at all. It's profoundly inelastic. So, what does that mean? Let's go back to our pond analogy. The efficient market hypothesis says when you throw a pebble, representing a flow of money, into a pond, it creates ripples that quickly fade away. The pond's overall water level remains unchanged. The Inelastic Markets Hypothesis, however, argues that the pebble somehow magically adds water to the pond. The impact isn't temporary, it's permanent, and it's massively multiplied. According to Gabay and Koijin's model, for every $1 of net inflow into the stock market, the market's total valuation increases by approximately $5. Let that sink in. This isn't just saying that buying pressure makes a stock go up. It's saying the effect is astronomically larger than anyone previously imagined. This multiplier effect turns our understanding of market mechanics on its head. The key to this theory is the idea of a limited pool of value-sensitive investors. In the old model, the market is full of discerning investors ready to sell if a price gets too high. But in the inelastic model, there simply aren't enough of these rational sellers to absorb the massive, price-agnostic flows of money coming into the market today. This is where the theory gets its power and where it connects directly to your life. The primary driver of these massive flows? The single biggest financial revolution of our lifetime: the rise of passive investing. For the past 20 years, money has been pouring out of actively managed mutual funds, where a manager picks stocks, and flooding into passive index funds and ETFs. We're talking about trillions upon trillions of dollars. When a pension fund allocates $1 billion to an S&P 500 index fund, that fund manager doesn't ask if Apple is overvalued or if Tesla's PE ratio makes sense. They have one job: to buy the stocks in the index in their prescribed weights at whatever the current price is. They are, by definition, completely insensitive to price. This is the engine of the inelastic market. It's a relentless one-way fire hose of cash being sprayed at the market. As Jean-Philippe Bouchot, a physicist and chairman of hedge fund CFM who has championed this theory, put it bluntly in an interview with the Financial Times, "The whole bull run is because of an influx of money into the market. Think about the incentives. Every payday, millions of people's 401ks automatically buy into index funds. Every day, investment platforms see net inflows into popular ETFs. This creates a constant, structural demand for stocks that didn't exist on this scale 30 years ago. Meanwhile, the ranks of traditional, active, value-conscious investors, the very people who are supposed to provide the elasticity by selling when prices get too high, have been shrinking. Their business model has been decimated by the low fees and solid returns of passive funds. So you have a scenario with massive, indiscriminate buyers and a dwindling number of price-sensitive sellers. The result? When a huge wave of money comes in to buy, there's no one to meet that demand without prices being pushed up significantly. The market becomes a one-way street. This theory provides a compelling explanation for the market's seemingly Teflon-like resilience over the past decade. A global pandemic? The market roared back. Wars? Inflation? The market dipped, but the underlying upward pressure from these flows has been a powerful tailwind, constantly pushing it higher. It suggests that the weighing machine has been overwhelmed by the sheer force of the voting machine, and the vote is always buy. So, if this relentless flow of money has been the secret ingredient to a decade-long bull market, what happens when the music stops? What happens if the flow ever reverses? This is the dark side of the Inelastic Markets Hypothesis. The multiplier effect works both ways. If a $1 inflow raises the market's value by $5, the theory logically implies that a $1 outflow will cause the market's value to drop by $5. Imagine a scenario. A generation of baby boomers who have accumulated vast wealth in their passive retirement accounts starts to systematically sell their holdings to fund their retirement. Or a severe and prolonged recession forces households to pull money out of the market to pay their bills. If the inelastic markets hypothesis is correct, the effect wouldn't be a gentle, orderly decline. It would be a cliff. For every $1 billion in net sales from ETFs and index funds, the total market could lose $5 billion in value. A trickle of outflows could trigger a torrent of selling. A market that has been artificially inflated by price-insensitive buying could be brutally deflated by price-insensitive selling. This is the fear that keeps some market observers up at night. They see a system that has become dangerously dependent on a constant forward momentum. It's like a shark that must always swim to survive. If the inflows slow, or worse, reverse, the entire structure could be at risk. Is this, then, a giant bubble? Proponents of the theory are careful. Bouchot describes it more as a long-term upward trend, driven by a structural change in how markets work. But the mechanics are eerily similar to a bubble's feedback loop. Inflows push prices up, which attracts more inflows, which push prices even higher. The difference is that this loop isn't driven by irrational exuberance for a specific asset like .com stocks or houses, but by the systemic, automated process of passive investing. It's a bubble created not by madness, but by cold, automated logic. Now, it's important to approach a theory this revolutionary with a healthy dose of skepticism. The Inelastic Markets Hypothesis is compelling, but it's not without its critics. The world of economics is rarely settled, and many argue that this paints an overly simplistic picture. First, there's the argument of other factors. To say that the entire bull market is just because of flows is a bold claim. What about corporate profits, which have been incredibly strong for many of the largest companies in the world? What about the era of historically low interest rates that followed the 2008 financial crisis, making stocks the only attractive place to put your money? Critics argue that the hypothesis downplays these fundamental drivers. Technological innovation, especially the rise of AI, has created genuine, tangible value in companies like Nvidia. That's not just a story of money flows, it's a story of real economic growth and future earnings potential. These fundamental factors, they argue, are the true weighing machine at work, even if they're noisy. Second, some question the stability of the 5-to-1 multiplier itself. Is it a fixed law of nature, or does it change over time? In a panic, for instance, might the multiplier become 10-to-1 or even 20-to-1? And in a calm market, might it be closer to 2-to-1? The model's elegance lies in its simplicity, but the real world is messy. The exact impact of flows likely depends on market sentiment, liquidity, and a host of other conditions that are constantly in flux. Finally, there's the question of whether the market really is as inelastic as the theory suggests. While passive funds are price agnostic, the market is still filled with other players. High-frequency traders, hedge funds, and yes, still some active managers, who are very much paid to spot and correct mispricings. They might not be as dominant as they once were, but they haven't disappeared. If stocks became truly, absurdly cheap during a sell-off, isn't it likely these players would step in to buy, providing a floor and restoring some elasticity to the market? The Inelastic Markets Hypothesis offers a powerful new lens, but it may not be the only lens we need. The truth, as is often the case, is likely a complex interplay between these new flow dynamics and the traditional fundamentals of value and earnings. So, where does this leave us? We stand at a fascinating crossroads in financial thought. On one side, we have the classic efficient market hypothesis, the reassuring image of a rational market, a great weighing machine delivering fair value over time. On the other, we have the Inelastic Markets Hypothesis, a more volatile, chaotic vision of a market held aloft by a torrent of money, where flows are king and the fundamental value is a secondary concern. The rise of passive investing has undeniably changed the game. It has democratized investing for millions. But it may have also introduced a new systemic fragility that we are only just beginning to understand. The Inelastic Markets Hypothesis provides the most compelling framework yet for explaining this new reality. It tells us that our collective actions as investors, the simple automated act of saving for retirement, have a vastly amplified impact on the market we are all a part of. We are not just passive participants. We are the engine. The great financial story of the last 20 years has been one of relentless ascent, fueled by this engine. The great question for the next 20 is a simple one. What happens if that engine ever sputters? What do you think? Is the market an efficient weighing machine, or is it a swimming pool at the mercy of the inflow pipe? Has this changed how you see your own investments? Let us know in the comments.